If you are planning to tokenize a real asset in 2026, this is the actual sequence, in order. 7 steps. Most of them are legal and operational, and exactly one of them is choosing software. One warning before we start. A lot of the guides you have been reading describe rules that no longer exist. Europe's prospectus exemption changed on the 5th of June this year. Step 1. Nobody buys a building. They buy a claim on a legal entity that owns a building. Getting that entity right is the whole job, and it is the step people skip because it does not feel like technology. 4 common wrappers. An SPV holding a single asset, a series structure with one series per asset, a fund vehicle where the token is a fund interest, or a debt issuance where the token is the bond itself. That choice sets everything downstream because 4 forks decide this entire process: what you are selling, where your investors are, whether the instrument is a security, which for a real-world asset it almost always is, and who legally holds the record of ownership. That last one is the step that actually breaks. 2 warnings. If you are pooling money from multiple investors into a vehicle you manage, you may have built a fund, which is a heavier regime. The SEC flagged exactly this for tokenization models in January. And bankruptcy remoteness is a legal property, not a word you put in a deck. It comes from separate entities, separate books, and no commingled funds. This is the biggest fork in the video, and nothing in it is universal. In the United States, the default is a private placement under Regulation D, and it splits in 2. Rule 506B lets you include a limited number of non-accredited investors, but you may not advertise. Rule 506C lets you advertise to the world, but every single purchaser must be accredited, and you must take reasonable steps to verify that. You cannot have both. What actually gets filed is one notice, Form D, 15 days after your first sale. There is no pre-approval and no review. That is why this route is fast, and it is also why nobody has checked your work. And here is what tokenization does not change. Securities sold this way are restricted. Under Rule 144, the holding period before public resale is 6 months for a reporting issuer and a full year for everyone else, which is what almost every tokenized SPV is. Your smart contract has to enforce that. If you want retail investors, Regulation A is the route, capped at $75 million a year in Tier 2. But it is a real review. Staff must qualify you before your first sale, and then you are subscribed to ongoing reporting. In Europe, start by throwing out the most common mistake in this entire subject. MiCA does not govern your tokenized bond. Article 2 excludes instruments that qualify as financial instruments under MiFID, and MiFID was amended to say explicitly that it covers instruments issued using distributed ledger technology. There is no MiCA license to tokenize a security, and asking for one tells everyone you are in the wrong regime. What did change is the money. Since the 5th of June, a member state may exempt an offer from the prospectus requirement where the total consideration, aggregated across the union over 12 months, sits below 12 million euros, or 5 million if that state picked the lower option. The old 1 million euro floor was deleted outright, and it does not passport, so exempt in one country is not exempt everywhere. Germany adds a gate nobody expects. Under the Electronic Securities Act, the register recording who owns your crypto security is a licensed activity. You hold a BaFin license, or you hire someone who does. You cannot self-host it. Switzerland is the cleanest contrast. Its DLT Act creates the ledger-based security through a registration agreement and properties of the ledger, with no register license at all. One last thing, because the crypto press has reported it into existence. The SEC's innovation exemption for on-chain trading is not law. It has not been proposed and it has not been adopted. The chairman said in April that the commission was, quote, on the cusp of releasing it. 3 months later, it is not on the regulatory agenda. Before anything is minted, legal title has to actually move into the issuing vehicle, and it has to be recorded wherever the law says ownership is recorded. For real property, that is a county land record, not a blockchain. You have seen what skipping this looks like. A company called Realty collected $2.72 million from investors for a bundle of Detroit homes whose purchase never closed. The legal owner was still the seller. At one address, Realty sold over $100,000 in tokens for a house whose recorded deed belonged to a man who had never heard of the company. In total, roughly $94 million in tokens against about 700 properties, while lacking demonstrated clear ownership of nearly 100 of them and about 300 missing the transfer paperwork Michigan requires to record a sale. The token ledger was perfectly consistent with itself. It was just never anchored to the record that decides who owns a house. The counterweight, and it matters, The on-chain data is how outsiders proved all of that. Reporters cross-referenced public token records against county deeds. Try that with an opaque private syndicate. Two separate checks protect you here. An appraisal says what the asset is worth. A title search says the seller can actually convey it. They are not substitutes. This is the only step most guides cover, and it matters least until the first three are done. For the chain, serious issuers optimize for predictable fees over cheap ones, and time to finality over headline speed, because settlement cares about irreversibility. Watch the layer 2s. Instant feeling networks can take hours to reach hard finality. For the standard, the landscape is stranger than it looks. ERC 3643, authored under Tokenize leadership, went final in December 2023. Identity registry, trusted claim issuers, compliance checked on every transfer. ERC 1400, the one you have probably heard called the Security Token Standard, has been self-declared draft for nearly 8 years. It was never merged into the Ethereum Standards repository. It has no page there today, and its discussion thread was closed as stale in 2022. It sees comparable production use anyway. Formal standing and market adoption are two different things, and the largest platform by assets uses neither. Securitize runs its own protocol. There are also chains with compliance built in natively, including Polymesh, Solana's token extensions, and XRPL's multi-purpose tokens. Now the vendors, and there are two structurally different kinds. Some platforms hold their own regulated licenses, so you do not need yours. Securitize in the US with a broker-dealer, transfer agent, and trading venue. Arcax under the FCA, ADDX in Singapore, 21X and Assetera under the EU's DLT pilot regime. Others sell you software and you bring your own regulated wrapper. Tokeny, Fireblocks, Taurus, Bricken, Polymath, Bitbond. The question to ask is not which one is best. It is whether that vendor's license does the regulated work, or whether you still have to go buy that separately. Whatever you pick, the transfer restrictions have to keep working after launch. A whitelist that checks a wallet at purchase does not satisfy a restriction that runs with the security. Status changes, holding periods run, and countries get sanctioned after your sale closes. In the US, there is no single SEC rule ordering a private issuer to run KYC. What actually drives it is the verification duty under 506C, the anti-money laundering obligations of whatever regulated intermediary is in your deal, and sanctions screening, which binds everyone. Accredited means $200,000 of income, $300,000 jointly, or $1 million in net worth excluding your home. And here is the shortcut most issuers still do not know about. In March 2025, SEC staff agreed a high minimum investment is a relevant factor in verification. Require at least $200,000 from an individual or $1 million from an entity. Take written representations, have no knowledge to the contrary, and you can reasonably conclude you have done enough. No tax returns. Two separate vendor categories serve this. General KYC, where SumSub, BlockPass, Entrust, Identify, and Jumio compete, and US accreditation verification specifically. Though for that second one, the answer is often a lawyer's letter or a large enough check, not a vendor at all. Europe runs differently again. There is a statutory withdrawal right. Publish a supplement to your prospectus, and investors who already committed can walk, now 3 working days. A US private placement has no general equivalent. If a broker-dealer is involved in an all-or-nothing offering, escrow is not optional. SEC Rule 15C2-4 requires funds transmitted promptly to an escrow agent or separate account, and nothing reaches you until the minimum is met. The escrow bank must be unaffiliated with both the broker-dealer and the issuer. On Rails, neither answer is the compliant one. Fiat settles into a bank account your auditor can reconcile. Stablecoin settles on the same network as the token and can make delivery against payment atomic, but brings valuation timestamp and provenance problems. And a caution for this whole category. Prime Trust was a Nevada-chartered trust company widely used as a crypto custodian and escrow agent. It filed for bankruptcy in 2023 with up to $500 million in liabilities, after losing access to a wallet and using over $76 million of client fiat to cover withdrawals. The words regulated and trust company did not prevent that. 3 custody postures. Investors hold their own keys, the platform holds them, or a licensed custodian does. And the US trigger is the one people invert. It is not that the asset is tokenized, it is who the investor is. A registered advisor with custody of client assets needs a qualified custodian, tokenized or not. Anchorage, BitGo, Tangany, Taurus, Fireblocks, and Copper all serve this category. the step everyone underestimates, and the one that ends the argument about the token layer. The official register is the legal record, not the chain. Even where the register lives on-chain, there is a name attached to every position, and reconciling the two is a permanent duty, not a launch task. Somebody has to be the transfer agent. In the US, Securitize, Computershare, and North Capital all do this. In Germany, the register you are legally required to outsource is served by CashLink, DekaBank, SWIAT, and Tangany. Though good luck shopping it, BaFin's public list of who holds that license was repealed this year, and no replacement exists. Then, the permanent costs your launch budget forgets. Register maintenance, distributions with correct withholding, investor reporting, corporate actions, tax, and enforcing those transfer restrictions forever. And when you go looking for liquidity, the secondary market is not one pool. T0, INX, RCAX, ADDX, 21X, and Assetera each run their own onboarding and user base. Tokenizing on one platform does not get you liquidity on the others. So does any of this work? The SEC's own economists looked at 10 years of Regulation A. The median offering sought $10 million. Among the issuers that actually reported raising anything, the median was $2.3 million, and roughly 380 qualified issuers reported no proceeds at all. And in their words, for the majority of Regulation A offerings, quote, a liquid secondary trading market did not exist. Around 2% got an exchange listing. That is the honest frame for every cost in this process. Judge it against the raise you will actually achieve, not the one on your cover page. Because tokenization changes the transfer mechanism. It does not manufacture demand. Every step in this video makes a security transferable, compliant, and correctly recorded. Not one of them creates a buyer on the other side. New episode every week for the people actually planning to tokenize large things. Subscribe.